My name is Phil Traxler. I'm with Eide Bailly. I've worked with Eide Bailly now for the last 7 years, primarily in loan file review and a little bit of due diligence work with our bank clients. Prior to that, I spent 25 plus years in banking, and both in bank management and commercial lending, and started out my career in New Ulm, where I met Mike Dove. What we want to talk about today is COVID-19 and some of the impacts we're going to see in your loan portfolio and your collateral values. We can all look around and see that potential vacancies are coming in a lot of this commercial real estate, and fearing what the results of that might be. So what we want to do is talk about that a little bit today, maybe bring up a few best practices that might help counter that. During my loan file review, I just want to talk a little bit about what I see out there in the bank portfolios right now. Obviously, I'm seeing the SBA PPP loans on the books that are out there. I don't see that as a negative at all. It's basically a expense reduction for the operations that have obtained it. In terms of debt service on that PPP loans, I don't look at that. I really just assume that they're probably automatically going to be forgiven. What else am I seeing out there? We're seeing the payment deferments that are out there in round one that were allowed under the CARES Act. And it always begs the question whether the payment deferments like that are TDR. At this point, no. They were very specific about that it will not be a TDR if it's listed or the payments are extended. But I guess it begs the question, it increases the risk a little bit, but are those extensions P&I or just interest only? In most cases, we're seeing that the amortizing payments were extended to maturity and interest was paid. In some cases, like I said, we're seeing interest only as well. What we're also seeing is diminished cash flows out there. That's evident. We think the bulk of that is going to come later. Like I said, we're starting to see the forgiveness applications as well. And to my knowledge, I don't believe any forgiveness applications have been approved by the SBA at this point, but we'll have to wait and see. We've also heard through the grapevine or heard through the systems that the PPP fraud appears to be rampant. We've heard a situation where there's a lot of fraud out there, where there was an NFL player and 10 of his friends applied for a $25 million PPP loan. So with that having said that, it appears as though the FBI is probably going to be busy with a lot of that rampant fraud in the PPP program. Extensions, I mentioned that a little bit earlier. We've seen that out there during our course of loan file review. But what I have seen in one bank that I was in recently, that a loan officer took it upon himself to continue to extend. He went through the 90-day extensions for a lot of the amortizing payments and took it a little bit further and kept extending everything, even the single pay notes. And the bottom line, this was a $1.3 million credit for the entity and personally. And by the time I finished my review on that credit file, I found $60,000 worth of accrued interest, of which the borrower had no ability to pay. And at that point, you're looking at a substandard credit and probably ultimate foreclosure because there was no ability to pay at that point. But overall, the results of what we're seeing now from this pandemic are going to be very, very evident at the end of the year in 2020, when we start to see those tax returns and year-end audits and financial statements. Right now, there's just not a lot to see out there, other than we know that there's issues in a lot of these cash flows for these entities. But one other issue that's out there right now too, that I wanted to touch on a little bit too, was just the unemployment issue as well that we know that is coming. Pandemic is having a negative impact across most industries. Are there exceptions out there? Yes. Northern Minnesota, the resorts are having a tremendous year. Even Jim LaPierre just mentioned this, that they're seeing that from the FDIC as well. Boat dealerships don't have any inventory. It's sold out. ATV and travel trailer sales have been very, very strong. So at the same time, we've got a lot of issues out there in terms of credit issues and poor cash flow, but we've also got these industries that are doing very, very well. One thing that really impacted the resorts in northern Minnesota was the fact that the Canadian border was closed and still closed, and probably not going to open anytime soon. But that's, like I said, really had a major impact on the resort industry in northern Minnesota. Industries identified earlier in the COVID-19 pandemic process is heavily impacted. Obviously, airlines, casino and gaming, leisure and sporting activities, auto parts and equipment, oil and gas, although recent reports from the oil and gas industry is that things are improving. Crude oil price for a barrel of crude has been up and down, but mostly it's been up lately. And like I said, the oil industry is reporting improvement in the oil fields. Local negative impacts. The one I really see is first and foremost is non-owner occupied real estate. And those types of properties we think they're really going to have some issues out there right now. Examples of that are obviously going to be office facilities, i.e. in downtown Minneapolis, retail shops, hotels. Is a big issue that the regulators brought up this morning as well, is that the hotels are really going to have trouble and going to be a focus between the hotels and the restaurants. It's interesting to see our offices in downtown Minneapolis, and I've been going to the office from time to time over the last 2 to 3 months, and it's surprising what you see there. I would estimate the workers downtown Minneapolis right now are probably somewhere between 5 to 10% of what you normally saw. And that has an impact in every business down there, whether it's restaurants, bars. A lot of the restaurants and retail shops have closed up. In fact, they're boarded up right now. So we think it's still going to continue to have really a negative impact, especially with non-owner occupied real estate. One other thing that the negative local impact as well is going to be the unemployment. Unemployment remains high. As of September 2020 in Minnesota, the unemployment rate is estimated at 6%, versus last month in August, it was 7.4%. So obviously improving. Last year, the unemployment rate was 3.2%. So based on what's happening, you would almost assume that rate might be a little bit higher, but it's definitely improving. Industries with minimal impact from the coronavirus pandemic: property and casualty insurance, healthcare and real estate, multi-line insurance, life and health insurance, industrial real estate. And that's another thing that the regulators mentioned this morning, that the industrial real estate really hasn't been impacted at all. It's very, very strong yet at this point. From a local and regional standpoint, where should the bankers' focus be right now? Obviously, I think it should be concentrated in non-owner occupied real estate, hospitality, industry, retail, and hotels. Ag real estate's also an issue out there right now, or has been an issue. In fact, that has been the focus of the regulators for the last 3 to 4 years. But we've seen a great deal of improvement in the ag industry right now. The ag real estate values are solid. A lot of investor activity yet there. In terms of ag commodity markets, they're stronger. Yields this year are up, and the harvest conditions have been good, and harvest is probably wrapping up in the state of Minnesota right now. With the COVID pandemic, where do we focus now? Obviously, as always, if you're a banker, cash flow is always king. Focus on the borrower's ability to cash flow and pay attention to the occupancy rates and rent rolls. Also pay pretty close attention to your borrowing guarantor balance sheet strength. Do they have an equity burn rate? If they're losing money on their cash flow, what's their burn rate? Also, working capital has always been something to maintain. If they're having operating losses, I would assume that we're going to see the working capital deteriorate. What can you do? Complete a collateral review. If you're concerned about your collateral value, especially with commercial real estate, evaluate the occupancy, cash flow, and location. Where is it? That's another thing the regulators really emphasize this morning, is that the location of these properties and location of the operation itself, it can be vastly different from one portion of the state to the next. A lot of times when you get into a situation where you potentially got a borrower default, especially with commercial real estate, is a new appraisal required. A lot of times the regulator is going to say that yes, they are, if you are aware of a decline in value. But at this point in time, in practicality, it doesn't make a lot of sense to do an appraisal because those property values are going to be fluctuating a great deal. At this point, if you're concerned about the property value, and internal evaluation might be a good short-term option, using the property cash flow and or any comparable sales that might be there. Commercial real estate collateral value. Appraisals are always dependent on sales and income. Comparable sales, and right now, like I mentioned, there probably is not going to be any out there if you need to do an appraisal on something, and they're probably going to rely heavily on the income approach, which if the cash flows are hampered, there's not going to be a lot of cash flow there. Cap rates. Moody's released anticipated cap rates that might be used in some of the appraisals that you're looking at. Starting list, we've got apartment buildings at roughly probably an estimated 7% cap rate, industrial properties at 9%, office at 17%, retail at possibly at 19%, and leading the league here is the hotel units or leisure at 21% estimated cap rate. Pandemic. What are a few best practices to move forward at this point? Keep your borrower financial information current. Balance sheets, typically you're probably requesting annual balance sheets versus quarterly. Might be a good time if you notice that there's some stress with the operation to start requesting quarterly balance sheets. That way you can then accurately take a look at their working capital. Income statements. Obviously, we generally work off annual tax returns and our audits, but is it time to possibly start requesting quarterly statements? Rent rolls for non-owner occupied real estate I think are going to be very, very important at this point because we think a lot of the stress, that's where it's going to come from because there isn't going to be a lot of cash flow. And a lot of those commercial office facilities, apartment buildings, we're going to see vacancies. So make sure you keep your file properly updated with rent rolls. Past due credits. Once we have problem loans, we know we're going to have past due credits. Be proactive with your past due loans. Make sure that the payment deferments are not going to trigger a TDR reporting. There is talk that with a potential stimulus bill, there might be a second wave of payment deferments that might be available. But at this point, you know, with split Congress right now and the White House up in the air, we don't really know where it's going to go other than the fact that we know we're going to have split Congress again and legislation to pass through there might be an issue, might be a problem as it has been for the last couple of years. If you've got issues where you're considering a TDR, if you've got issues like I mentioned earlier where the extensions got out of hand with the loan officer that just extended everything, you're probably certainly looking at a TDR, but as Max mentioned earlier, probably not something to really be afraid of. You have to set it up as a TDR. Problem loan credits should probably have proper problem loan reports prepared. Usually I would suggest on a quarterly basis, but with problem loan reporting and problem credits, the all important question to ask is always, are you going to work with or work out? Once you ask that question and answer it, your action plan going forward is going to be pretty straightforward. Maintain a well-structured credit relationships and sustainable accommodations. Maintain appropriate loan amortizations and be careful with extensions on single pay notes. Stick with your standard amortizations with what the industry expects. Commercial real estate, I would recommend you shy away from those 30-year amortizations on commercial. But make sure your loan commitments and loans that you're writing are appropriate with current regulation. Both actual and cash flow, projected cash flow are going to be very important. And take a look at your cash flow projections and make sure that your projections are realistic based on historical income expense. Accounting and regulatory reporting. Loan modifications need to follow GAAP principles. We want to make sure that you address the accrued interest if extending any payments and or single pay notes. Section 4013 of the CARES Act allows for the TDR relief. We talked about that a little bit already. But however, be aware of the second round deferment may change this. We'll have to wait and see. The other thing we want to make sure you pay attention to is your all methodologies. Are they still appropriate? With this pandemic, something that we've never seen before, is it time to address your ALLL methodologies and whether or not they need to be revised? Because like I said, this pandemic that we're seeing right now is historic. We've never seen this before. A couple other things in conclusion, make sure you be aware of your negatively impacted industries. They're all different and they're affected by regions in the state. They're all different and not the same. Keep credit files current, keep your financials current, your rent rolls, make sure your file comments for problem loan credits and PLRs are up to date and realistic. But like I said, going forward, make sure you keep your financials up to date and hopefully the tax return deadline won't be extended again because we all know that analyzing the tax return that's a year old, it doesn't do a lot for your credit analysis. Let's all hope that for later 2020 and 2021 that somebody comes up with a vaccine and we can move on from this problem.